Hey everybody, welcome to Mortgage Today for Monday, January 29th, 2024, and oh, what a day it was. UMBS were up 5 basis points bright and early this morning. Interest rate futures now predict 5 interest rate cuts this year. While I'm inclined to disagree with that view, though, things could definitely change in the Middle East, could cause our forecast go completely off the table. It would be likely that the Federal Reserve Chair Powell will do what central bank officials almost always do when flags wave and bullets start flying. It is said that the first casualty of war is truth, but that might not be true. The first casualty of war is sound monetary policy. If the United States finds itself in a major war, and Iran is a far more formidable foe than Iraq or Afghanistan, it will be damn the inflation full steam ahead at the Eccles building, so everything could change with what's going on over there. The economic data calendar this week will be highlighted by the FOMC rate decision on Wednesday, as well as the Powell presser that will follow. It is widely expected that the board will hold rates steady again. It'd be the fourth meeting in a row that they do so, and its current 5.25 at its current 5.25 to 5.5 level. The excitement will be trying to decipher any hints about where the Fed sees monetary policy going forward. Till Wednesday afternoon, investors may keep their cards close to their vest. In August, the Fed funds rate was at 5.25, while the annual core PCE price inflation was 3.7%. This means the real inflation-adjusted short-term interest rate was 5.25 minus 3.7, which is 1.55. On Friday, the inflation number fell to 2.9, which means that the real short-term rate is now 2.35%. If the Fed wanted to maintain the same level of monetary tightness that it had in August, it could cut the Fed funds rate by 75 basis points, but they won't. The last mile in inflation is always the hardest. The Fed is probably happy to keep rates high as long as the economy continues to expand. That said, they have room to cut rates even taking into account their dual mandate. Note that rate cuts are not the only issue the Fed is considering. Quantitative tightening is another. Fed has indicated it will reduce its balance sheet at a slower pace, meaning letting fewer treasuries mature without replacement, which should help lower the 10-year rate, at least at the margin. They don't intend to do that with the mortgage-backed securities. However, their portfolio is so out of the money, they really aren't getting much runoff in the first place. Diving into 2023's production via NMLS, looking at 234,000 records, Ingenious found that only 24% of originators did 24 units or more. So only 24% did 2 loans a month, 30% did 18 units or more, which is a loan and a half, and 40% did 12 or more units, and 60% did 5 or more units. While the official quarterly Treasury refunding announcement hits at 8:30 a.m. on Wednesday, the preliminary notes just came out, and bonds like what they see. The most relevant newswire was the Treasury expects to borrow $760 billion in January to March, down $55 billion from the October estimate. Bonds started the day off in slightly stronger territory with gains both Asia and Europe overnight. The bulk of the domestic session was flat and uneventful until the 3 p.m. Treasury refunding update. This isn't the official announcement, that's on Wednesday, but offered a hint of what's to come. Specifically, estimated borrowing needs dropped more than $50,000 for the quarter, not a significant amount. Specifically, estimated borrowing needs dropped more than $50 billion for the quarter. Specifically, estimated borrowing needs dropped more than $50 billion for the quarter, not an insignificant amount. The bond market agreed with yields dropping immediately in response. 10s and MBS ended the day at the best levels of the week and a half. While that's a nice little victory, where we go from here depends on the incoming economic data. MBS closed the day up 14 basis points on the 6% at 101.19. The 5.5 picked up a little bit of extra ground to that, but ending up at 101.19 is putting us right in this very tight technical range where we have the 25-day moving average average as a ceiling. We have the 50-day moving average as a bottom and a very strong Fibonacci floor. So we'll have to see how that plays out with new data. We also got international news that Chinese real estate developer Evergrande has been ordered to liquidate. Evergrande was one of the first and biggest property developers to default. China has been trying to support the economy via stimulus measures. However, property prices continue to collapse. China is in the early stages of something similar to the U.S. Great Depression and Japan's lost decade. It will be interesting to see how this impacts national security issues.